All right, so here we are. This is the first time we're getting together in the new podcast studio. It's Dan Kelly, Tom Morison, Amara Mortgage Brokers, and Viola Wealth. And kind of getting together, I guess, today to talk about some hot topics, what's on the coalface. Do you want to tell us a little bit about what you do and a bit of a Cliff's Notes version?
Yeah, maybe we should tell the audience that we obviously know each other prior to this.
Totally.
We spent many years in the trenches at one of the major banks. Westpac, you were a mortgage broker that I did a ton of business with. We became, close personal friends after that.
Yeah.
Navigating the incredibly complex world of credit.
Yeah.
And trying to understand where the bank's appetite was. We're very successful with that, and we've stayed in touch for a long time. But I'm the CIO at Viola Private Wealth, so we're an ultra high net worth and high net worth private client business. So we deal with individual investors, family offices, institutions, endowments, not-for-profits. The way that I really explain to people in very simple terms what we do is client gives us $1, it's our job to turn that into two and that two into four, right? So we're professionals with portfolio management, asset allocation, and structuring of investment portfolios. And so, C-suite executives, entrepreneurs, business owners that have some type of liquidity event don't necessarily have expertise in finance, maybe haven't made their money in financial markets, and they need someone to guide them through that process, and that's what we do.
Yeah, and I think that's why we became good mates and we did a lot of work together, is because we naturally had a really similar level of clientele. Our Amara, is Tina and I, and we focus on complex credit, complex client needs. And naturally, we attract that more sophisticated type of client who likely has a few properties, likely has a private wealth manager, and doesn't fit a box. And if they walked into a branch, they'd probably be declined by every bank in Australia. And naturally, that's where a lot of the solutions are found, is in private bank, like in Westpac, for example.
Yeah, and I think, look, credit to you for kind of having the crystal ball to realize and double down. And I know personally you love challenges, you love leaning into adversity. That's something that excites me as well. You had the crystal ball to kind of set your firm and Amara up to kind of go down that niche. We're going to talk about the budget and some of the impacts and unintended second and third order effects off the back of that. But really what it's created for both of our firms is an environment of higher complexity. And I think we're particularly well placed to kind of help guide clients through that.
Yeah, certainly. I think as we go into this, you think about it, right? Like we've got clients who are 30, 40 years old. They have their kids. Their kids are like 11 or 5 or whatever, and they're growing up with AI, right? We grew up with smartphones. They're growing up with AI. They're literally going to get to the point where they probably will just trust AI inherently, and it will be just as good as it would have been for the average mortgage broker, in my personal opinion, I think.
I agree.
And so when you kind of, I sort of had that foresight, Tina had the foresight, and we have the skill set to be able to cater to that more sophisticated type of client. And I think what will eventually happen is you'll see a bunch of consolidation in the mortgage broking industry, where your smaller operators that just, do your 2 pay slip kind of transactions, they'll be swallowed up by major banks deploying these big models that just kind of approve a loan immediately, and you can get your outcome really quickly. And because mortgage brokers are pretty good at what they do, we're providing a lot of education out there into the marketplace. We're educating everyone.
Yeah.
So overall,
you're training the models, ironically.
We're literally training. We're training the models. So I think, I'm not too averse to that. At the end of the day, like, all that's happening is life just gets faster. We're getting a lot faster. And if you come to me and all I can do is point to a screen and say, here's your lower rate, we're the opposite of that. Yeah. We're trying to be the opposite of kind of an order taker. So I think that's definitely where it's going. There's certainly going to be a lot of consolidation. The simple vanilla, quote unquote, transactions will totally be swallowed up by the major banks and these big AI models, which people, as they come up, from being children, trusting AI, will trust inherently. Yeah. And so we definitely wanted to and our skill set, and that's why we did a lot of business together, basically.
Yeah. Fantastic. I'm kind of here for some personal interests and personal reasons, because I think there's no one better placed than Amara. You and Tina are kind of at the coalface with a lot of these changes that are kind of prominent front page news in the budget at the moment. Yeah. So maybe we can go through them one by one, what you're seeing from the clientele, outlook on the market. Let's start with negative gearing, right? No more.
Buzzword.
Has been abolished.
Killed.
I remember when we were doing, obviously, big transactions at Westpac, when you tick that negative gearing box, all of a sudden the borrowing capacity increases 20, 30, 40%. Yeah. That is now completely removed. Yeah. What are you seeing, I guess, from your existing clients in the pipeline I guess, any impacts on sentiment for maybe families or households that were looking to purchase their second, third, fourth investment property that now maybe can't?
Yeah.
And what are those households looking at doing with that money now?
Yeah, I think what's really interesting to talk about on the, I mean, there's obviously some subsects of negative gearing that are still going to stay around. If it's a brand new property, or if you buy an existing property and you demolish it and you build a duplex, you can still, you're adding to the supply. So you can still negatively gear those kinds of properties. And we might see more clients maybe take on the mum and dad developer hat and try to do it for that reason, because perhaps that's the only way they can access the borrowing capacities, by accessing the tax benefits. Certainly from budget night, we had a few clients kind of crawling around, and I think it got leaked, quote unquote, probably intentionally, as politicians do.
I think that might have been deliberate.
as they look to kind of get some feedback, some initial feedback on the policy. And I had clients calling me, trying to beat down my door within literally 1 or 2 days. They'd roped in a buyer's agent. I just said, look, this isn't the right way to buy a property, just because potentially there's some tax changes coming up. And I was surprised myself personally when it was retrospective to 7:30 on budget night.
Yeah.
I don't think really many people were expecting that. Really doesn't allow for the strategies that we'd put in place over months and months, and for some people years, to come to fruition. From budget night, we had 10, 20, 30 pre-approval, whatever the number was, and that were affected as a result of these changes.
Yeah.
And immediately those pre-approvals were void, like immediately. And they weren't void because the bank wrote to them saying it's void, but they were void in the sense that all of a sudden the bank wouldn't honor the pre-approval. The banks didn't know themselves. We were reaching out to the bank saying, look, what's the guidance here? We've got clients in the middle of exchanging, in cool-offs. What's the guidance?
Yeah.
And they didn't know themselves. And there was this massive vacuum of sentiment, massive vacuum of confidence to be able to continue through on an active pre-approval and convert and buy a property immediately. The banks that eventually came out and clarified their policy positions. Some banks pulled out right away. And others kept the negative gearing in the model on the basis that the legislation wasn't passed. Obviously, the legislation has now passed. It's basically on its way to royal assent and will become law very shortly. And so therefore, almost every bank has taken the button out of the model. And certainly for new investors, borrowing capacity is reduced by 20, 30, 40%, massive hit to borrowing capacity. And as a result, total investment strategies are having to be redrawn.
I think that there's a big thing here where because the Labor government essentially wasn't given a mandate to do this, and they kind of changed their position very famously, and that will go down in Australian politics as a very famous line.
Yeah.
A lot of institutions and the banks couldn't front run this.
Totally.
They were also caught kind of unaware of these policy changes, and so it was at the 11th hour at midnight, all of a sudden it's changed. Now everyone's running around trying to work out what to do.
Yeah.
One of the cohort that I think wasn't considered as part of this, I think obviously these policy changes were intended to affect that high income earner purchasing their fourth, fifth or sixth property to try and take some demand out of the market, to try and help the first home buyers understand the principles of it. But I think one of the cohorts that wasn't thought through as being affected by this is the rent-vestor.
Totally.
So the first home purchaser that is buying an investment property legitimately to rent that property out for 2, 3, 4 years, help get some additional borrowing capacity through the rental income, and then potentially look to move into that property in the future.
Yeah.
They're now completely priced out of entire suburbs.
Totally.
Now. Yeah.
Totally. It's often it was the young woman or young man living at home, university, just graduated, got his first job, got her first job, a year in, still living at home rent free. Let's get into the property market. It's a goal they've been saving there. They've been filling a bag of chips at Macca's, saving those dollars and waiting for that opportunity to come and invest into the market. At least they can get into the market so that they don't have to save as hard, because now all of a sudden they'll be saving and the property will be growing in value. And what's happened is this removal of negative gearing has just taken one of those aspects away that helped just get into the market. In those kinds of scenarios, it was often an investment in another state, in an emerging market, in a different state, or we're obviously here in Sydney. It's obviously difficult for a first home buyer anywhere to buy. And so it's just another tool that's been taken away from being able to get into the market. And often that rent-vest strategy was used to grow equity, sell the property, and then buy the owner-occupied. Or if it was in the area that they were living in, move into it eventually once they could afford to do that.
And that investor would have screened in the statistics as an investment property purchaser,
Yeah,
not a first home buyer, but
Yeah.
really they're kind of thinking more longer term with their strategy.
totally.
Something else that's unintendedly affected that cohort is obviously the changes of moving from that 50% 12-month CGT discount
Yeah.
to the indexation model
Yeah.
has been applied across all asset classes, not
Mm.
just residential investment properties, which was very controversial.
Totally.
So that's now going to affect things like ETFs, managed funds, crypto, where I think younger and younger individuals and couples were kind of using that as a method to keep pace
Mm.
with the increases in the Sydney and
Yeah.
Australian property markets, because it's very difficult to outsave the market.
Totally.
So
It's not
now,
possible. It's not possible.
not possible.
Yeah.
I agree. Yeah,
Yeah.
absolutely. So now, the ultimate effect is they're going to have less after-tax dollars in their pocket to pay that first deposit.
Yeah, and we saw a trend probably over the last 2 or 3 years, particularly where a lot of the first home buyers that we had as clients had their money and their cash, their savings was in ETFs in order to keep pace with it and grow their deposit faster and enter the market faster. And obviously these changes, I guess, they're across the board, right? So there's no real way around them in terms of investing in other asset classes and things like that. Certainly it will just delay the ability to be able to get into the market as a result, because you have to pay more tax.
Yeah.
When you realize that gain, when you come to, and it's not realized right away. If you're smart, you'll sell down. Depends when you want to buy, obviously, but close to the start of a financial year. But then obviously you've got to pay the tax eventually. It's not like you can delay it either, and it has to be factored in up front as well. So I think it will come to a bit of a shock for a lot of people who have taken that approach, because it takes years to get into the market, 5 years, 6 years, 7 years of saving, investing, and all of a sudden now you've just had another couple of years added to the timeline as a result. Yeah,
exactly. One of the things, so we did a budget analysis white paper at Viola, and just focused on some of the second and third order effects that I think was probably missed in a lot of the mainstream commentary. And one of them was the ability to borrow against existing investment properties and owner-occupied properties.
Yeah.
To take out a line of credit to invest in other asset classes like private equity and venture capital, hedge funds, infrastructure, listed equities, fixed income. That is now, in my opinion, going to become a really effective tax debt shield, because you can still claim 100% of the interest cost on that loan as tax deductible.
Yeah.
So whilst you can't do that in a negative gearing sense with an investment property, 100% of the interest will remain as tax deductible. Have you seen more investors, or do you think more investors will start to kind of pursue a strategy like that as a alternative to the only world that they used to know, which was to buy the next property?
Yeah, I definitely think so. I think these changes will help people to realize that you don't just build wealth in Australia through property. It's intergenerational. The your mum and dad, grandparents bought a property anywhere in a capital city, and it did really well. It was best performing asset class that certainly the kids saw. And as a result, that was passed down to the parents and passed down to the kids, our generation. And so it's always been property. It's always been buy property, get in as soon as you can, hold on to it forever, and you'll be set. And I think that philosophy is being questioned, actually. And it's being questioned in a really big way, because there's such a dramatic change to legislation as it affects property. You have to reconsider it. It would be remiss of someone to still invest in a property without considering those changes, without considering other asset classes as a result. And certainly we're starting to see that on the coalface. We're getting more inquiry for debt recycling for existing homeowners. We're getting more inquiry for, okay, well, if I buy this property as an owner occupied, perhaps I just, maximize my purchase price instead of buying other investment properties, so I can, that property will increase and there's no capital gains tax on the principal place. And then you debt recycle from there to take advantage of kind of that you have your cake and eat it too.
Yeah.
And so we're certainly seeing a lot of that. Certainly in the modelling, that while the button for negative gearing has been removed for existing properties, residential properties, that button's still there for shares. That button's still there for managed funds, bonds, whatever. And as a result, the borrowing capacity can be recovered when you consider changing the asset class. And negative gearing is a buzzword, but so is debt recycling. And debt recycling has become kind of the hot topic. And we're seeing it a lot on Instagram, seeing it a lot on LinkedIn. A lot of people are talking about it. And it's because of this pivot into reconsidering only property as the asset class. Instead, and for those who don't know, debt recycling is simply paying down your owner-occupied loan and drawing equity back out on a separate loan and investing it into something else, like shares. And there are particular products that AMP have, AMP Master Limit, that helps you do it more efficiently. But certainly we're seeing a higher number of inquiries on that basis, for sure.
And you just personally helped me do this, right? This
Yeah.
is exactly what we did.
Yeah.
We borrowed some money against some existing properties that I've got. I invested that into offshore, so primarily North American private equity and venture capital funds, which is kind of where I see probably the best place for a marginal dollar at the moment. They're kind of in a decreasing interest rate environment. There's a ton of innovation and disruptive tech coming out of that country. But we use the residential real estate as security for that.
Yeah.
You don't get margin called. So it's not just property that kind of a mortgage broker can kind of actually help with. You're kind of the one-stop shop for all leverage and debt.
Yeah,
and
that's right.
And that leverage and debt can be used for a range of different purposes.
Yeah, and you know what I think really interesting is you could theoretically take the leverage out on the property, but you could then potentially take out a margin loan on the equities themselves. So potentially you could recover it. But I think that the actual funding of you made a comment offline about funding with debt, funding with leverage, is a really important part of the strategy, because you obviously can go the other way on you as well, right?
Absolutely. Yeah, you got to be super careful with leverage, particularly when you move outside real assets.
Yeah.
And I think particularly if you're an individual that's, quite au fait with purchasing property, and maybe you already own a few investment properties, but now you're looking to go into other asset classes where maybe you don't have as much depth of expertise in. Be super careful of leverage.
Yeah.
Because there's a very famous saying, ladies, liquor, and leverage are the three ways that any smart person can go broke.
Totally.
So to be used with caution can be a very powerful multiplier, but that works both ways, right? Up and down. SMSF, limited recourse borrowing, is no more.
Yes.
We did a little bit of this at Westpac.
Yes.
Not a huge amount. Would love to hear from you some of the unintended effects with this as well, because I know that even some business owners were looking at purchasing their going concern business within the SMSF. I understand that's not affected.
Yeah.
But it was a strategy that the major banks were initially going with, and then they had kind of pared that back. Maybe talk through what you're seeing on that side as well.
Yeah, SMSF lending's been around for a long time, and initially the major banks were all over it. St. George, Macquarie Bank, and AMP, they all offered limited recourse borrowing arrangements, which is the type of product, it's the name for the product that a super fund will use to borrow and leverage for a residential or a commercial property purchase in a self-managed super fund. And there was a couple of inquiries. Was it going to be banned? Is it going to be allowed? Should you be allowed to have leverage in a super fund? Does it encourage you just to have one asset in the fund and no diversification? And so eventually, there was a few inquiries. They decided to keep it. Major banks pulled out because there was a couple of inquiries going on, and the void was filled with non-bank lenders. And so since then, we've seen banks like lenders like Latrobe, Liberty, First Mac, Pepper, you name it, Bluestone, and they filtered into this space in a big way, and they filled the void and fueled the demand, which was ever increasing for LRBAs. And we've seen it just year on year, an increase in level of inquiry. And I think the reason for that is because you can access an investment property without having to impact your personal cash flow. Just pays with your super contributions, pays with your rent, any other investments in the fund.
Washes its own face, as we say in the industry.
Totally.
Yeah.
And it was a really good way of expanding your borrowing capacity further. If you had, reached your ceiling outside the fund as well, and you were, a stalwart property investor and didn't want to consider any other investments as well. So that's the reason it was really popular. And was growing in popularity, and certainly in the last 6 months, we've been fielding a lot of inquiry for this. I think it definitely came out of left field. No one was expecting to borrow for a residential property in an SMSF to be banned, and I think it's a bit outrageous actually that you have a situation where, not that I agree or disagree with the ban or that it should be allowed, but just the fact where you've got someone who, because you can't set up an SMSF, you can't set up a pre-approval, you can't buy the property in 5 days or 10 days like you can outside the fund. If you were an investor outside the fund, we'd get you an approval tomorrow, right? We do our statement of advice, do it very quickly, very good, and get you the approval. That's not possible in an SMSF situation. You've got to go through and get your statement of advice with
it's not easy.
Advisor. You've got to roll over, you've got to set up new insurances, roll over your retail or industry fund. You've got to set up 2 companies, trustees for the SMSF and the Bear Trust, which is the vehicle that holds the property. You've got to set up the Bear Trust. You've then got to have the cash in the bank account. Then you can get your pre-approval. And that takes months and like 10 grand, right? So all of these people have done that, and then they've had the rug pulled on them by the government. 45 days. I mean, that's crazy. That's just outrageous, actually. If they decided to do that, how can you require people to go? You can't unwind that. You can't get that cost back. And so all of a sudden, you've got a situation where we've got a mass rush of applications. We had a financial advisor I was talking to had given like 6 or something like that statement of advices where direct property was involved with leverage in a self-managed super fund. And as a result, all of a sudden we've got these applications going in. You know, we've got lenders at like 10 or 15 business days, which is it's a total mess. And you probably won't even have the approval by the time the turnaround time comes, let alone the fact that you're forced to sign a contract in the next 45 days. Yes, it's possible if you have a really good buyer's agent and they're aggressively looking for an A-class property, because you don't want to, you don't want to buy a B or a C class just because you got time on the clock. That's kind of what it could contend with. So I think it's more the time frame that is the biggest issue there with the change. But certainly was, and I think would have grown a lot more in popularity.
I think there's some fair criticism that, you know, if you are investing all of your super fund in a single asset, there's a lot of concentration risk. And I understand the concern about having leverage in the SMSF and superannuation system. I think it's not as if they have banned purchasing residential properties inside the SMSF, right, if I understand it correctly. And the upper end of town, those with balances of 5, 10, 15, 20 million can just go and purchase these assets with cash.
Yeah. I mean,
so ironically, it's Middle Australia and Lower Australia. It's actually going to be affected by this because they needed the leverage to purchase the asset.
Totally. You know, isn't that hilarious? You know, like we see the change of policy, and it's touted as this wealthy investors, 1% of Australia is buying property. And that's just, you know, the only people that are affected are your mum and dads with a family and have decided to buy a property in the super fund because maybe that's how they can afford to buy it. They can't buy it in their personal name because maybe that's affordability reasons or whatever. But all of a sudden that's not available anymore. But it is still available if you don't use leverage. So the genuine 0.1% aren't affected. But you know, the first home
who
buyer
often aren't.
So you got your maybe first home buyer or, you know, whoever wanted to buy that property in SMSF. You know, anyone who's not in your kind of 0.1% probably is the best way to describe it, is the people who are affected, which really I guess isn't the intended target.
Yeah, exactly. I think what we're seeing and what we're paying really close attention to is the wealth effect here. So with uncertainty comes people pulling back from the market, the whole let's wait and see approach. Maybe people that were going to go and participate in investing further dollars or in, you know, participate in the economy in some way, sit back and just wait and see for the dust to settle. We've seen auction clearance rates come back to COVID lows.
Yeah.
You know, so, you know, Spanish flu level lows, right? Incredible. Sydney, I think I saw dropped 1.1% last month. So these are big moves.
Yeah, can you believe that? Can you believe we've got, like, there's such a vacuum of confidence in the market that we are at the middle of COVID. The auction rate has not been worse since the middle of COVID, like since the gyms were getting
when the
shut.
planes were falling out of the sky.
The planes were stopped. You know, like we had masks everywhere, and I was in Woolies and everyone had a mask, and that person that didn't have a mask was going like this to, you know, like that kind of craziness is the level we're at in terms of confidence in the property market right now. It's actually quite fascinating, and as a result, I think we're going to see this whiplash effect. I think we're going to see this effect where borrowing capacity comes back a lot, which it has. Sentiment comes back a lot, which it has. And then all of a sudden there's a normalization of sentiment. And there'll be this bull rush. There'll be this rush back into the market once that the first parts of confidence emerge, whether that's with a rate cut maybe, because, you know, the wealth effect, whether that's with, you know, maybe a change of government and the policies are reversed. I think, and so as a result, we get this whiplash effect going. Just like we saw in COVID. Actually, it could be worse, actually. We could see a pump of the property market that is stronger than was the recovery from COVID as a result of these changes, I think.
Yeah, and look, it's something that it shouldn't be the case, and traditional economics always assumes a rational investor. We're emotional creatures, we're human beings, we're fallible, but when you log into your real estate, you know, .com.au app and you see your properties increased in value by $200,000 or $300,000, all of a sudden you feel okay with purchasing the car, even though you're not using the property to purchase the car. And it shouldn't make sense, but it does. The wealth effect is that you kind of feel better with spending money if you feel that your net worth is increased, because relative to your net worth, it's a lower amount. So if that kind of feedback cycle starts, then it can really put the brakes on the economy. Ironically, it could actually do some of the RBA's job for it, because the inflation is going to come down if we're starting to see housing and rent is one of the main inputs to it. So what are you seeing from your high net worth clientele at the moment? Are they viewing this as a short-term purchasing opportunity, or are they kind of also sitting on their hands?
We certainly have a situation at the moment where they're taking advantage of the lower market. We've got clients that are rushing in, getting pre-approvals, getting ready to go. They're looking for, the typical definition of an investor is buying something for less than it's worth, right? We have clients at the moment that are looking in the market, looking for that opportunity. And I think it's really interesting how it kind of turned on a dial. We've seen a situation where investors are now prepared to get into the market at a point only when they're buying below the guide price. Before, the guide price was always below the purchase price, and it's spun on a dial. So certainly, I think because of the type of clientele we have, where we're dealing with more, complex credit needs, and they tend to be more sophisticated as a result, to get into that situation of complexity, they're kind of looking at this in a more logical way. There's actually a sale going on right now in terms of property prices are on sale, basically, and it's cyclical, just like markets always are. So certainly we have a lot of pre-approvals at the moment that are being set up as a result of these changes. Certainly there are people that are sitting on the fence. There always will be personal circumstances. I'd say in majority though, there are certainly savvy clients that are looking to take advantage of this what I would suggest is a temporary pullback in the market prices.
There'll probably be a few months of price discovery, right? Because I think both the seller and the buyer is kind of reassessing what that property's worth.
Yeah.
It doesn't surprise me that the auction clearance rates have pulled back significantly, because you went to market expecting a certain sales price. You were convinced by the real estate agents that the property was worth that. All of a sudden, the buyers aren't showing up.
Totally.
But it will take some time for expectations to readjust.
Yeah.
So I think, there'll be a period of weakness. But yeah, typically it's during periods of dislocation that the savvy investors start to look at putting dollars into the market where it makes sense. We did a bit of analysis around this. And one of the things that I wanted to talk to you about was there was also some big changes to CGT.
Yeah.
So there was the 50% CGT discount. We touched on it before, that you were eligible if you held a financial asset or any asset for 12 months or more. We're now moving to the indexation model. You'll pay significantly more tax under the indexation model, right? Lo and behold. We took a look at the before and after tax returns of a range of different asset classes. And I know you were kind of asking about this off camera. Where I think you'll probably see the most relative weakness is asset classes that were producing growth returns. So not producing growth returns, but at levels where you could get an income equivalent. So what I mean by that is an income producing investment is taxed at your highest marginal tax rate. That was the same before as it is now. So no change to the after tax return for bonds, private credit, fixed income instruments. What really gets affected is things that sit in that middle camp that are producing around the 8 to 10% return level, but it comes all in capital growth, because you would have been eligible for that discount before, which would have helped the after tax return.
Totally.
So that's kind of where we're seeing, maybe some purchasing preference, movements. The biggest relative change has been private equity and venture capital. The highest returning asset class of them all, you're typically expecting 15 to 20% per annum from that. So really strong compounding, but no income at all.
Yeah.
It's pure growth.
Yeah.
And so obviously that gets hit to a really significant extent when you're going into some funds and, and assets that have done 2, 3, 4, 500% returns over a really long period of time. With our modeling, even though you'll pay more tax if it's a capital growth focused investment, it still is the highest after tax return. One of the things that I wanted to talk to you about is what could come out as the king of all asset classes if we see property prices continue at somewhat of a similar level as before, is the owner-occupier property.
Totally.
It's the only truly tax-protected, insulated asset in Australia now, right? Even our superannuation is getting taxed at Div 293. So Do you think that there's going to be significant flow of funds into unoccupied properties for people trying to get into that tax haven?
Yeah.
Are you seeing any discussions with clients at the moment of them looking to sell up their investments and go in and pile all of their chips into one ONC?
Yeah, we're seeing heaps of it. Actually, we've got numerous scenarios on our desk at the moment, which is modeling out, okay, how many properties do we need to sell to buy the owner-occupied property, which probably is now being brought forward, really is what's happening there. There's almost like a redistribution, selling, getting the contract date before the changes come into effect in 12 months' time, whatever. And then redistributing those assets into an owner-occupied property.
Yeah.
I think it's more of a it is an investment decision, but it's blurring the lines between what is an investment and what isn't an investment. And traditionally, an owner-occupied property is bought with emotion.
Yeah.
It's bought in an area where you want to live, raise your kids. Just plan how many kids you can have. And now all of a sudden, potentially, there's going to be a mindset shift. It's like, okay, actually, that comes second, and first comes return on capital return.
Yeah.
Good luck getting that across with the wife, right? But
Yeah.
I think certainly there are.
Oh, look, honey, we have to buy this. I've modeled it out. That's definitely not going to work.
Look at this comment.
Yeah, I've got a spreadsheet. I know you wanted to live in Bondi, but I've actually modeled out this Western Sydney suburb, so we're going to have to go there, unfortunately.
Oh, I love it.
Yeah.
And there's nowhere wrong with Western Sydney. It's probably performed better than Bondi.
Absolutely.
Anyways.
Yeah.
So yeah, definitely we're seeing it. I think it goes without saying, but you just don't make your decisions based off tax policy, right? I think it's a consideration. It could be the case where the policy's totally changed with the next government, and all of a sudden you've decided to crystallize those gains, sell down those properties, which you wouldn't have otherwise done if it wasn't for that policy.
Yeah.
So I think it's a bit of a grain of salt with that. Certainly it could change the upcoming strategies though, that's for sure. And it's a very difficult decision because, if you've got to decide whether you have a larger owner-occupied mortgage, it might affect your lifestyle, it might affect where you live, where you have your kids. Obviously, it talks to the rent vesting strategy. It talks to the strategy of kind of the in-between where you live not exactly where you want to, but you still have the security of an owner-occupied property, or you just buy an owner-occupied property only.
Yeah. I mean, it's one of the things that I think it's always said in finance that tax is an outcome, not a strategy.
Yeah.
It was a thought experiment that I was going through where, typically investors purchasing, investment properties are quite price sensitive and logical, right? They look at, am I overpaying? What's the rental yield? They're more factual and kind of analytical about their purchasing decision. Owner occupiers purchase with emotion, right? And we kind of made a joke about it before, but it's very important what your partner wants, what's right for the family. And so it's not uncommon to pay overs on that property or that house that you fall in love with because it's a lifestyle that you're buying, not necessarily just the asset.
That's right.
So I was theorizing, will all of this demand coming in with more emotional purchasing actually push prices up over the longer run? And then what effect does that have on the overall market and debt levels in Australia? So it's fascinating to kind of think about. I think, is there any other trends that you're noticing in Amara on at the coalface? Anything that is kind of in the minds of the clients that you want to kind of go through?
There's a couple of comments I'd make on that. The first comment is suburbs that are in inner city suburbs and renters in those suburbs. So I think there'll be a normal sales process of investment properties as there has been for various reasons, buying the owner-occupied property, deceased estate, whatever. But they won't be replenished. And as a result, rents are going to skyrocket in the inner city suburbs.
I agree.
They're not reclaiming land out of the ocean and building houses in the ocean on the reclaimed land. That is absolutely going to be a serious issue. So I actually think that what that will lead to is potentially more gifts being given from the boomers to their kids. Maybe they sell earlier. There's a bunch of unintended consequences there. Actually, I think we're yet to see. I think we'll see a change of approach when it comes to investors. Now, they'll be forced to from a borrowing capacity standpoint, but perhaps now they chase yield. And we haven't traditionally seen that with property investors. It's always been, okay, what can we carry and let's go for gain. And perhaps now it's yield, just like you were talking about before with the income as well. And that will mean different areas. Traditionally regional properties are better yielding. Capital growth isn't really there. And we also see, and I think we'll also start to see a retool of investment strategies.
Yeah.
We'll start to see commercial property considered, which is dangerous, actually, I think, because we'll have mum and dads that are looking for commercial. Oh, great, we'll buy the shop front, main road, vacant, whatever, but we'll just get a tenant in there. Totally ignorant or potentially of actually how it works. And they can get hit the hardest, actually, by allowing commercial properties still to be purchased in the SMSF and in your personal name with the negative gearing as well. It's a different assessment process, different lending, different criteria. It's just totally unknown. You don't have any of that intuition that's brought forward from your parents, from the general, barbecue, what have you. So I think we'll see a bit of that. But I think kind of the biggest trend we'll start to see is this real change of strategy when it comes to, do we buy owner occupied or do we buy investment? Initially when I started my career 10 years ago was, okay, it's buying the owner occupied. Then it changed to go back to okay, now it's going to be a rent-vest strategy. I think now we'll probably see a reversion back to the mean in that regard.
I think at the end of the day, look, the core tenets and principles of good investing remain the same, right? Buy quality assets, diversification, ensure that you're not just putting all of your eggs in one basket, and you're kind of assessing as logically as you can the purchasing decision. Tax policies will come and go. Governments will come and go. Who knows whether all of this gets repealed in the next 5 to 10 years.
Totally.
That's absolutely on the cards. But I think so long as you kind of keep those core tenets at the front of your mind, and you're purchasing high quality assets that are going to grow over the longer term, you'll absolutely be fine. But it is fascinating to see. We're going through, Australian politics used to actually be a kind of unintended benefit of Australia, that we didn't really change things too much. And so the stability of the political environment made it quite attractive to build businesses here, because you kind of didn't have the rug pulled out from underneath you.
Totally.
I think that's changed now.
And
even for offshore investors, they're probably reconsidering Australia.
They've changed their position.
They've changed, and that will absolutely go down as one of the most famous lines in Australian politics. But look, these things can change, and I think we need to ebb and flow and adapt with this. And I think the way that you've set Amara up, this is a benefit for us at Viola, because we kind of specialize in helping clients navigate the minefield of tax structuring and investment strategies. And look, nothing is ever simple or easy in our world. And that's exactly why we exist, because, the business owners, founders, C-suite executives that come to us with a life-changing amount of money or a liquidity event, not necessarily made their money in financial markets, and they need someone to guide them through that process. And so, look, that's what we're here for.
Totally. I think what's really interesting with that is, those types of clients then go out and, they're not unaffected by these changes. They might pay cash for real property instead of taking out a loan. And all of a sudden we come into the picture, and they need to re-release that equity to invest in those managed funds and to invest in that private equity. And those kinds of circumstances, they might have had a liquidity event. They may no longer be a business owner. They might be asset rich, but income not so rich. And all of a sudden, those are the types of clients that really struggle to get access to credit. You wouldn't believe it. If you're in the States, people would be barging down the door to give those types of clients a loan. In Australia, it's actually really difficult if you're in that situation, if you're not with a broker or at a lender that actually is able to understand those kinds of circumstances, to actually get a loan. We have a lot of those kinds of circumstances where we'll have a client that's you got a significant amount of assets in the tens of millions of dollars. Maybe they're retired, maybe they're on the way to retirement, maybe they've decided to stop working so they don't have to work. And all of a sudden, because they don't meet the serviceability test, because they can't show that they can afford their groceries, believe it or not, because they don't have income, the lender won't give them a loan. And rightfully so in some cases. I think it's more just about understanding the exit strategy, and we do a lot of that kind of stuff here. So I think what ends up happening is we end up having a lot of types of clients where they've gone to the mortgage broker on the main road, or they've gone to their bank, and their bank's knocked them back after 30 years. And we end up kind of coming through and in a much better way as well.
We always used to explain it, and when I was a private banker, the way that I used to explain it was, there's regulatory risk and there's credit risk. And you can have something that has almost no credit risk. There's first way out, there's an asset to sell. There's no way that the bank or the lender is going to lose money on this, because there's a very clear way to repay the loan. But the regulatory boxes that APRA and ASIC make the banks jump through, they just can't get it across that reg risk bucket. Look, I came here today from personal reasons. Because I was interested to see what you guys are seeing on the coalface, because I think a lot of the budget changes are affecting particularly the real estate agent industry and the mortgage broking industry. So it's fascinating hearing what you guys are seeing. Let's see how the next few months go, right?
Might be filming this next week, mate. It changes again.
We'll probably have to put in a monthly episode or something like that to stay up to date with it. If they change their position again. But I really appreciate the conversation. Thanks for having me. Let's stay in touch.
All right.